I can't shake the simplest feeling beyond the ghost.
Testing.
We stand on the opposite shore. Hello, Ramona. I reach through mysterious ceilings, my holy hope. I look for the thing.
All right. Well, hello, DMV. This is Ramona Jones McClain, and I am your insurance guru. And we are here today broadcasting from 11707 Wrighterstown Road, where we talk about all things insurance. And I want to thank my audience for being a part of today's show as we discuss those things that are important to our financial wealth and our financial growth. Today's show is all about financial planning, how to get back to the basics. In these times post COVID, as we go through some of the financial challenges that we've had, we want to take that. What do we need to do to get back on track? Most of our issues right now is debt, and that is because we got flooded with opportunities during COVID, right after COVID, to put cash flow into the economy to keep it driving. Now they're trying to remove cash flow in order to reduce inflation, because inflation is really high right now. But what does that mean for you, the end user, and creating a situation of financial health? And how does financial health affect your insurance? It affects your insurance because, as I talk about all the time, your insurance score. Your insurance score is based, depending on the state, sometime between 10 to 35% on your credit score. And how do we create a good credit score? Hopefully, we have a guest that should be coming on to talk about how to develop a good credit score. But let's talk about your financial plan. Financial planning is not as complicated and it's not as in depth as the CFPs try to make it seem. It is necessary because it's a practice that helps you to track and manage your money. You know, that's one thing you can say about Oprah Winfrey. She knew where all her money went. And you'd be surprised. You would think that the most financially independent or richest people in the world would be frivolous with their money. But in fact, it is quite the opposite. Usually they have their money because they know what they're doing with their money and they're paying attention to what things cause great effect and what things don't. And you do this with a purpose of reaching a goal. What is the goal that you want to reach? The purpose of reaching their goal. So your goal can be to buy a house. It could be to buy a car. It could be to save up enough money to pay for your children's college in full. It could be to buy an investment property or to buy the family farm. Whatever your goal is, set your goal, know what the cost that you need to achieve, the money you need to achieve in order to get there. And then understand it's important that when we're setting our financial goals, we look at items that are appreciating assets. And those are things that grow. So you want your money to make money. You want to invest in something that is going to increase in value the longer you have it. That's a good investment. When you invest in things that are for convenience and comfort, those tend to be fleeting. After a few years, the value of them drastically decrease, or the use of it becomes obsolete because it breaks down or it malfunctions and it has to be maintained. And that's the other thing. When we invest in something, you also need to include the cost of maintaining it because there is cost associated with that. Can you do maintain the upkeep and the necessary things that allows that item to retain at least most of its value. So all of those things go into setting your goal and determining what your priorities are with your money. And whether they are short-term or long-term goals. There are a lot of CFPs. I was studying it one time to be one to help you be able to do that. So there are 6 steps, of course, in creating a financial plan. The first one we already discussed, which is setting your financial goals. Whether they are goals over 5 years or 20 years, short term or long term. One of the things you want to look at that thing is how much will it cost? What is the deadline? And where should I store my funds? This brings me to a question that came up. Let me see. Okay, as soon as I find the question. Here it is. So Sarah from Anne Arundel County, her question is, I always start out saving and then I end up using the money. Well, that's not uncommon, okay? That's not uncommon because the whole point of you saving is because you can't come up with the amount all at one time. And what you want to do is, and that was the third part of question number one of the object of number one, which is setting your financial goals. You need a place where you can store the money into an account that is not easy for you to withdraw out of. So if you absolutely have to withdraw out of, you have to go through several steps in order to get to it. And this could be in a retirement annuity. This could be in a CD, certificate of deposit. You can use all kind of mechanisms. You could put it in just a regular savings account, where you need 2 signers to withdraw the money out. So you get on there with someone else, and in order for the money to be withdrawn, both of you guys have to sign. There are also accounts with American Express as well as SoFi, and there are all sort of financial mechanisms that are available in order for you to um, limit your access to the funds. You can also put the money into a life policy, and you can overfund a life policy, which allows the account to build up while you're saving for the things that you're trying to get. So these are all the different vehicles. And when you speak to a financial professional, they can guide you in the direction of which one is most effective and most convenient for you. But I think the key is, if you're going to put money aside for something, is to find that particular thing that is going to best suit your character and your personality on how items should be saved. Okay, then track your finances. Of course, tracking your finances begin with a budget. First way be able to track your money is know who you're paying, how much you're paying, and what's going out. Then align that with how much money is coming in. Once you get a grasp of your spending habits, then you know what you need for what, and you'll see what's available for you to put aside. You also know what you're spending too much on. For me, at least once a year, it's usually around this time, I kind of go down my bills and I'm like, oh, I'm paying way too much to this phone company. And I'll get on the phone with them. I'll take a day, usually it's a Friday morning before I come into the office, and I'll get on the phone and say, hey, you're charging me way too much for this, this, and this. I would like to give you an opportunity to keep my business. What can you do to lower my payments and minimize the cost of your service? And I give them that opportunity. I give several companies I've worked with in order to do that. And I tend to do it at least once or twice a year, especially, after you've been with the company, the bill just sort of starts encroaching upward, 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 upward. And we can't do that. We need to keep the bill here, not let it go like a ski slope and you riding up. So that's something that you want to take the time to do. You need to set. You need to take a look at everything you're paying and go down the list. And that includes insurance companies. Insurance companies, if you have a good agent, when your policy renews, they're calling you and say, hey, I noticed your bill went up. And that's going to be happening a lot. A lot of insurance bills are going up. Why? Because that is the market we're in right now, and rates are increasing in order to decrease the effect of losses that are in the market. We cannot avoid that. But you individually can look at your account and see what savings is there and what's available to you. Ultimately, honestly, the insurance company's got to get the money somewhere. So if your rate went up, I don't know, less than $100 for 6 months, I would probably stick where you are. Because it's pretty tough out here right now, and the insurance industry is not in a great place. Not in a great place at all. Let's see. So we did our budget. We saw how much we were paying out versus what we are bringing in. And then we need to create an emergency fund. This is get my car fixed fund, a I don't have any lunch money today fund, a fund that allows you to be able to take care of something that you did not anticipate coming up. And you don't have to put a lot away from that for that. It could just be $20 a paycheck. That can go into your options for that. $20 a paycheck. That's what it could be. If in fact you don't have an opportunity to do that, one of the things that I do is I have an emergency credit card. I put it to the side, and if something comes up that I need, I use that credit card. That just gives me the opportunity to have what I need in case something happens. Like, I don't know, the telephone gets turned off when you come in the office one Monday and realize that you forgot to pay the phone bill last month. Those things happen. It happens to everybody, especially honestly with me, with caring for my husband, trying to maintain my business. I don't know, almost slicing my hand in half, trying to finish his construction projects at home. Somehow, and everything that was getting paid, the Verizon bill did not get paid. So I came in one day, and the phones were not ringing. Why are the phones not ringing? So I'm trying. The internet wasn't working. I'm trying to figure out what's going on. Lo and behold, I didn't pay the phone bill last month. So I had to call them and pay the phone bill for last month and this month, and put it on what? My emergency credit card. That's what I had to do. But I have something set aside. Now I got to pay that off in order for that to be not affect. The next item on our list is our debt. This is the biggest thing that affects our credit, our debt ratio. What is a debt ratio? Debt ratio is the amount of credit you have used versus the amount of credit that you have. A good percentage is to stay under 30%. So if you have a credit card with $1,000 on it, you should not be using more than 300 at one time. Anything above 30% negatively impacts your credit. The fact that you have a credit card and you do have credit option is a positive influence on your credit. But the fact that you use max the card up every month negatively impacts your credit and shows that you are financially in a position that you are unable to potentially not be able to pay your bills. Unless it is that you bought a really big item and you just haven't paid it off yet. But the key is in monitoring your credit is to know what is the last date I have to pay this down before the balance hits my credit. And credit is fluid. It is not, oh, I got a 700 credit score and it stays there. You can do one thing, like, I don't know, max one of your credit cards out, and it can negatively affect your credit and draw your credit score down. So this is something, and before we go into our break, because we're going to break in a few minutes, this is something in which being aware and being conscious, you can at least attempt to eliminate things. Frankly, um, frankly, if you don't have the money, you don't have the money. And then thereby, that's a conversation. And we're going to talk about that when we come back. Thank you so much for joining us. And we'll be back in a minute. Hello, DMV. This is Ramona Jones McClain, your insurance guru. I am a farmer's agent located at 11707 Reisterstown Road in Reisterstown, Maryland. Here, you can call me at 443-660-7131 or listen to my show every Thursday at 3 p.m. at podbean.com, The Real Insurance Guru.
I look
As the road you travel changes, so can your insurance need. Talking with Farmers Insurance Agent Ramona Jones McClain can help you assess whether you're ready for the journey ahead. Call Farmers Agent Ramona Jones McClain today at 443-660-7131. That's Ramona Jones McClain at 443.
All right, we are back. Thank you so much for tuning back in. So listen, we were talking about debt and debt ratios and spending more than 30% on your car and how to reduce your debt. One of the things that I found with individuals who can't, who are having difficulties, is that when the creditor calls or the insurance company calls, you don't answer the phone. From my standpoint as your insurance agent, I'm not a bill collector. I am a professional risk advisor. I am here to help you assess risk, prepare for it, and insure it. If in fact there's an issue, it is better for you to call me up front and say, "Hey, I'm not going to be able to pay this," for us to be proactive. It's the same thing for your credit card companies. It's the same thing for your creditors, your mortgage company. There are all kind of methods and programs that are available to assist you when stuff happens. Because stuff always happens. Life happens. If you are aware of your financial situation, that means you've been doing everything we already talked about. You had a plan. You've been tracking your spending. You've been monitoring your accounts. You created your emergency fund, and your emergency fund went dry. Okay, and you're aware of what's in your budget and what you can do. You can have an intelligent conversation with your creditors, with your insurance company, on how to manage being able to pay what needs to be paid and how it needs to be paid, or if frankly you just can't pay it. And that's okay if you just can't pay it. But you can be able to have a discussion with them to see what recourse is available to you in that situation. I think that it is to no effect to ignore the call and keep moving. It does not help you get anywhere, and quite frankly, it may turn the issue into a bigger situation than it needs to be, or that it could be. Sorry about that. Yes, that it could be. But having a conversation, and you know what? I know the thing is that we hate to tell people that we can't pay them. We hate to tell people that I said I was going to be able to do this and I actually can't. Unfortunately, things happen and that's what you have to do. Things change and that's what you have to do. You don't mean to do it. You probably don't even want to do it. But it is better to have an honest, upfront conversation than to just avoid. Um, Moving on. Once you have your plan and you've been able to manage your debt, and that is making arrangements to pay your debt down and pay it down within a time frame, what you can afford and what you can consistently do. Once your debt is paid down, now we're talking about investing. And this is whether, again, you're setting up an annuity or retirement investment or investing in something that maybe is in your community or investing in something that's going to create rapid growth. Make sure you do your research when it comes to investing. Make sure you talk to a financial specialist. There are several automatic investment platforms such as SoFi, Fidelity Gold, and Wealthfront. They are ideal for new investors, and these robo advisors are flexible, accessible, and you don't need a lot of money to get started. Okay, and they will help you buy and sell assets. And that's again SoFi Invest, Fidelity Go, and Wealthfront. One of the things that I found when families get are the recipients of life insurance proceeds, they tend to go buy stuff. Again, try not to invest in things that do not appreciate in value. When you get your life insurance proceeds, of course, pay for the funeral and final resting of your loved one, but then take the money and invest it in something that will grow. Create a new business, create a new opportunity. In any case, don't just go buy you a brand new bed because you can, or a new car because now you can. Take this opportunity to create generational wealth. Create something that you can leave to your children and that your children can create income from. That's the things you want to look at when you're creating a financial plan. And of course, you want to plan for retirement. Retirement is going to be a very precarious word in the next 10 years. As we look at the effects of what is happening to the Social Security Fund, as we look at different opportunities that are available to us to put our retirement in, all of the aspects of what it means to retire, in addition to raising the retirement age from 59 and a half to 65, 65 to 67, 67 to 70. These are the changes that are coming down the pike, and these are the things that you want to examine when you take a look at your financial wealth. Look at the lifestyle that you have now and you getting up and going to work every day. What is in place to make sure that that lifestyle can be maintained? Will your house be paid off before your retirement? Will your cars be paid off? Will you need a new car? Will you have money, extra monies coming in beyond Social Security and your regular retirement check? Have you put in enough hours to even get Social Security? I mean, these are all of the things, the conversations that need to be had and the things that need to be discussed and looked at. And whether or not, instead of going on that cruise, you should take that cruise money and put it into a retirement fund and let it accumulate for the next 20 or 10 or 20 years. At the end of the day, it is about making smart decisions toward your financial goals. What are your financial goals? Are your financial goals to retire early? Well, emptying out your retirement in order to, I don't know, do whatever outside of buying a house is probably not the best option. But again, planning is individual to you. It is very specific to you, and um, you have to take a look at what vehicles are available to you. But as far as retirement, there's a statistic that was done by Insight Magazine in 2023. You can contribute up to $22,500 if you're under 50 years old. People 50 or older can add an additional $7,500, but keep in mind that you can't withdraw funds until you're 59 and a half. Another option is a individual retirement account, which functions similarly to a 401k, but is not sponsored by an employer. RAs are also tax advantaged accounts and are often more flexible. In 2023, you can contribute up to $6,500 if you're under 50 and $7,500 if you're 50 or older. You can also withdraw, but you also cannot withdraw until you're 59 and a half. And you shouldn't. You should hold off as long as you can in order to live the lifestyle you want. What are the benefits of financial planning? A well thought out plan helps you meet your financial goals without stress. Stress, which is one of the number 3 killer in the United States. Stress. It might seem stressful to start. Anytime you're creating new habits, you are rubbing against the grain of what you are used to doing. But in hindsight, you will find that you will be able to meet your financial goals, to do the things that you dream of doing, and to be able to do it without having to ask people for stuff or having to go through hoops. You'll be able to come up with what needs to be come up with. And not only will you better understand your finances, but you can have more focus on reaching those things through the steps that we talked about. And you'll probably reach your goals faster. We've got a question coming in. Let's see. Sorry. How do I come up with a financial plan when I have no money? I talked about this earlier. The way you come up with the financial plan when you have no money is to figure out where your money is going. If you are paying some bills, if you have a roof over your head, if you're driving around in a car, you have money. The question is, what are you using your money for? You need to examine what your money is going out and start to minimize the cost of those things going out. It could be refinancing your car and lowering your car note. It could be calling your cable company and saying, hey, you're charging me too much. What am I paying for? By doing that, you create the gaps in your budget, and therefore you can take that money and redirect it. I had a guy to call me the other day about refinancing my house, and adding my HELOC back in and just doing one loan and then paying off all my bills. He says that the amount of money I'm paying out each month, he can lower that to a third. But if I kept paying that amount each month, that I could have my house paid off in 7 years. 7 years. So one of the things, I talk about my Aunt Eva all the time. One of the things she did, she drove her car for like 30 years. I lie to you not, 30 years. And in fact, the car is still drivable and still sitting there. Once she paid her car note off after 5 years, she kept putting the car note aside for the next 25 years. So when she went to buy her next vehicle, and then if she wanted to go on the road or somewhere, she just rented a car. So when she wanted to buy her next vehicle, um, she took the money that she had been saving, the car note that she had been paying all that time, and she went in and she bought her next vehicle in cash. This is the thing. We get so excited when we pay something off, but that thing is in our budget. Instead of acting like it's paid off, if we put that money aside and keep putting it aside and still maintaining the lifestyle that we currently have, then that money can be saved and be used for that trip you want to go on, or purchasing your next vehicle in cash, or paying your house off early. That was one of the things that I did. I didn't do it to that extreme. When I refinanced my house last year, I kept paying what the original house note was. So I kept sending in $300 extra a month to cover, to go toward my principal to buy it down faster. Of course, insurance rates went up, and it hiked my house note up. I don't know, another $60 a month, but still, now it's still $240 extra going toward the principal to pay it off early. These are the little tricks that you can do, and you can, and this information is free. You can go online and just say, how can I reduce my debt? How can I save? And the question is, once you start saving, the question is, where do you save it to? Do your research. It's really important what you put your money in, because you want to put your money in, it's going to create at least a moderate or growth. That is so important, to create moderate growth or fast growth. Anything you understand, anything that's fast growth is riskier, and you have a high potential of losing your money in addition to gaining from it. But these are the vehicles in which are available that you can put aside money to create the sort of independence or the comfortableness that you are looking for. Quite frankly, sometimes we live beyond our means. I'm part of that. I am. Um, and it's a little different for me because I don't get a paycheck. My income is not always the same. So I can have 6 good months and things are consistent, and all of a sudden, I don't know, a hurricane comes, and or the rates go up, or something shifts and there's a purge and I start losing money. That's difficult for me to anticipate, but I can sort of create as even a flow as I can as I'm measuring and monitoring how this is working. Um, but it is a process. It's a continued process of growth and understanding, and looking at what's available to you in the market, and understanding the best way to use your money. The best way to use your money. Because it is your money, whether God gave it to you, if you believe that, or you went out and generated it yourself, or you go to work for a job every day. Um, you are expected to do the best with the resources that you are given and maximize its potential. In the Bible, it talks about the person with the 1 coin, the 3 coins, and the 10 coins, and how the master gave them these things and went away. And the person with the 1 coin was so afraid that he was going to lose it that he hid it. So when the master came back, he would be able to give it to him. You can't hide your money in order to keep it. Money is designed to grow. If you don't watch it, it'll fly away like an eagle. But you need to be able to look at where your money is going and to put it in places that multiply it. And unfortunately, that's usually not a car, unless you're buying a classic car that you're going to maintain its aesthetic as well as original historic value, and that will increase in value, but that's different. But again, it is really all about looking at the money that you're spending and how you're spending it and where you're putting your money. And if or not you are making the best decisions to decide if that is the case. So, hey, we're going to keep talking about financial products. Next week, we're going to talk about retirement and retirement venues. I hope my guest makes it. If not, it's just you and me, DMV. Yes, you and me. And we're going to educate ourselves and look at the process of what we need to do. I hope that today I have provided you with the insight to think through where you are financially and dig your way out. It is not the end of the line. All has not fallen to the wayside. It is possible to rise back up to the top, just like foam, and be light as air. That has been my prayer with my Lord for all these years. I want to get to the point where I am financially comfortable and I don't have to worry about money. Is that not everybody's goal? I do understand, but it is possible. It is possible to create assets that generate revenue instead of suck you dry. You just have to know how to do it, when to do it, and where to do it. I am Ramona Jones McClain. I am your insurance guru. You can reach me at 443-660-7131. You can also check out my webpage where all of my podcasts are listed at www.insurancegurumd.com. I'm also on Facebook and Instagram. On Facebook, it's Ramona Jones McClain, Farmers Agent, and on Instagram, it's Insurance Guru MD. If you like what you hear and you have questions, you want to set up an appointment, we are always here to service you. Thank you so much for calling. This is Ramona Jones McClain, your insurance guru, and we are out.
Hello, Ramona. I can't shake the simplest feeling beyond the ghost. We stand on the opposite shore. Hello, Ramona. I reach through mysterious ceilings, my only hope. I look for